Well, hello everybody and welcome back to the summer 2026 edition of the Muni Minute. I am John Muschalek with HilltopSecurities and I'm here with Tom Kozlik, also with HilltopSecurities. Tom is the head of public policy and municipal strategy here at Hilltop. Well, Tom, we have had all kinds of things going on. We've got equity markets sitting at all-time highs. We've got rates all over the place. We've got the geopolitical tensions. We've got 2.5 months in Iraq. We've got 4 years with Russia and Ukraine. We've got the municipal market has its own specific story, right? Investors are trying to read through this macro fog. So with that in mind, what is the short list of forces that could keep rates and municipal yields higher for longer, as you've talked about?
Yeah, I think it's the war, the escalation in the Middle East. I mean, that's the number one theme right now. Then you've got inflation. You've got also concerns about the U.S. fiscal situation kind of bubbling up as well. There have been a couple of folks who have been mentioning that over the last couple of weeks. But in a lot of ways, I think that if those issues kind of group together and continue to provide pressure, we could see higher rates for a little longer.
Okay, with that said, you have talked for a while now about how investors are getting a second look at some of the higher yields that we saw, last summer and beyond, right? Is that still true? And are investors getting that second look?
Yields are a little lower than when we spoke maybe over the last couple of weeks, but they're still a lot more attractive than I ever thought they'd be in May of 2026. We were coming into 2026 expecting that the Fed was going to lower rates at least 2 times. Right? Now we're getting to the point where most are expecting that the Fed might just sit back. They're going to analyze the data as it comes in, but most aren't expecting that the Fed is going to lower rates anytime soon. Right? So we are at a level now where investors, in my mind, should be kind of taking what the market is giving them, and they should be activating and looking at the attractive levels that the market is providing right now.
There's a second part to that, right? And that's the issuance. Issuance has been strong, and the demand for municipals has been the backbone of that. What is the real story in flows and municipal bond investor behavior this year?
Yes, so there hasn't really been that much of a surprise where issuance is concerned. Issuance remains pretty strong, close to where it was last year. The big surprise to me, and I think for most people, is the demand side, where demand has been really strong. I mean, we have seen $20 billion flow into municipal institutional funds so far this year. On a net basis, there's really only 2 weeks where fund flows were negative. Okay. Last year at this time, I think the net positive number was like $2 billion, right? So there's been a lot of money that's gone into municipal bonds this year, and that doesn't surprise me. I think that one of the big things that's happening and continuing to happen, because almost $2 billion flowed into municipal funds last week. I think there are a lot of investors who they're using municipals as a safe haven. They're seeing all this volatility that you were describing, and they're using municipal bonds as a safe haven.
Right. I saw in a note that you put out earlier this week that the municipal tax exemption is once again coming under attack. This is something that we talked about probably 18 months ago. Did not come to fruition, thank goodness. But walk us through what you mean when you talk about the municipal tax exemption and the threat to that exemption.
So last year, John, when we talked about this, there was an imminent threat because the Tax Cuts and Jobs Act from 2017 was expiring, and I was expecting that there was going to be fiscal policy that lawmakers were going to finalize, and they did back in July of 2025. Now, they didn't touch the tax exemption, but the reason why it is that I'm writing about it now is because about 2 weeks ago, the news came out that the U.S. GDP ratio is over 100% now. Back in 2010, when the Bowles-Simpson Commission recommended that they eliminate all tax expenditures, including the tax exemption, so again, that was December 2010, the debt to GDP ratio was 61. In 2017, when we lost the ability to use advanced refundings with the tax exempts, the debt to GDP ratio was a little higher, but now that it's 100%, that is a real number, and that should be a real concern that things on the fiscal side aren't getting better, and that if and when lawmakers start to look at deficit reduction, the municipal bond tax exemption could be put on the table.
Okay. Big picture, right? Things have not played out exactly as we may have thought this year, especially on the rate side. A lot of people say sell in May and go away. That's more in the equity side of life. But big picture, what are you looking for in the muni markets as we head into the summer?
Yeah, there's some good and bad with regard to what's happened this year. I mean, one of the good things, one of the first things that has happened is the first quarter GDP recovered from the end of last year, right? So that was a positive. One of the things that I'm really looking for with regard to GDP is whether or not the AI activity is going to be really driving a lot of the economic growth for the rest of the year. Because that's going to tell me whether or not what I'm really looking for is some kind of broad-based growth, and AI specific isn't broad-based. So that's one of the big things that I'm going to be watching for. Second thing, how that and just the larger circumstances play out with regard to municipal credit. We talked about the golden age of public finance over the last couple of years. We started talking last year about the post-golden age recalibration. So there's a normalization that I'm still watching. I'm expecting that upgrades are going to continue to outpace downgrades in public finance in 2026. I just don't know how much. I think that the ratio is going to be lower in 26 than 27. So that's one of the things I'm watching for from a credit perspective. And then the supply and demand dynamic is really one of the things that I'm going to be watching for very closely as well, whether or not that supply jumps up or falls away, and or, like I said, demand is a big issue. So I'm really watching to see if that demand is going to fall off. Okay.
Well, Tom, that's a great run through. Any final thoughts you would give to investors as we head into the summer?
Stay engaged. One of the things that happened, we've been in a specific trading range the last month or so, and one of the things that I think that investors might do is they might be waiting for a cooling off period where they get more information about, the war or the fiscal situation. In this case, that's not the thing to do. The thing to do is take advantage of what's happening in the market, because by the time things cool off, yields could drop.
And we see it in this market all the time, that when things change, they change quickly.
They do change quickly.
All right. Well, that's going to do it for this edition of the Muni Minute. Thank you, everybody.